This is the ICO Alert Podcast, episode 13. I'm your host, Robert Finch, founder of ICO Alert. ICO Alert maintains the only comprehensive list of every single initial coin offering. That includes all of the active ICOs that are happening now, as well as all of the upcoming ICOs. You can check out the full list on our website at icoalert.com. My guest today is Daniel Schwartzkopff, the founder and CEO of Crypto20. During the podcast, we'll talk about the Crypto20 index, why they believe index funds will outperform managed crypto funds, as well as recent updates regarding SEC regulation in the United States. Now, it's important to note before we get started that although we are discussing trading and the crypto market, none of this podcast constitutes investment advice, and it is strictly for entertainment purposes only. You should always do your own research and due diligence before making investment decisions. Without further ado, let's get to it. Daniel, thanks so much for joining me today.
Yeah, it's great to be here.
Yeah, thanks for coming on. I have a lot of questions here, so it's a pretty interesting project. Could you start off and just kind of explain to our listeners what Crypto20 is?
So Crypto20 is the first autonomous index fund. It's cryptocurrency only. And we'll be tracking the top 20 cryptocurrencies by market capitalization with it's kind of a hybrid type of fund, which means there's a cap weighting, which the maximum component weight is 10%. All of our, those hyperparameters were determined thoroughly via data science. And essentially what this aims to provide is a solution to people finding it incredibly difficult to invest in cryptocurrencies. There are thousands of coins to choose from now, and there's sort of high risk, extreme volatility, and sort of serious practical difficulty involved in buying and storing a diverse portfolio of coins. And what we also do is we rebalance this fund on a weekly basis, and that's a risk minimization and mitigation strategy.
Okay, interesting. So I want to kind of break that down. You said first you guys are making an autonomous index fund, so that would be similar to like how the S&P 500 is an index?
Absolutely. So we track the top 20 coins in the same way that the S&P 500 tracks the US top 500 stocks by market cap.
Okay, very cool. And when you said autonomous, how does that all work? Are you guys, do you have some kind of software that's automatically doing the rebalancing, or do you have to manually go in and, say, oh, this one hit the top 20, now we're going to sell number 21 and buy number 20?
So our entire backend has been coded. It's a sort of autonomous system. It runs various containerized services, and it connects to multiple exchanges across which we can execute a purchase order or sell order across various exchanges. So that's all automated, and it's index fund strategy is based on a set of rules. So it essentially removes the sort of emotion, human bias, and it enforces investor discipline. Sort of fund administrators will never be able to make rogue trades, for example, in an index fund strategy. For example, investing in a friend's coin or something of that nature, as the trading rules are public and it's something that we stick to.
Okay, very interesting. And you mentioned you shift every week, because obviously the top 20 coins by market cap, if anybody goes to coinmarketcap.com, you can see the top 20 there. Really, you can see all the 1,000 or 1,100 that there are now. But you can sort by market cap, and you'll see that throughout the week, if you watch it even for just a couple days, you'll probably see the top 20 shift around. Top 10 are pretty solid, but generally, like once you get into the top 20 or the top 30, you'll see those pop in and out frequently. So how are you guys going to deal with that when you rebalance on a weekly basis? Are you going to be selling things at a loss over and over because something will drop from number 20 to 23 and you have to buy the new number 20? Or could you give me a little insight into that process?
So what rebalancing does is it increases the possibility of median return. So that over many different rolling windows or test periods, rebalancing a fund, for example, it can be done on a daily, weekly, monthly, biannual basis. That essentially is a risk minimization strategy, because you're taking the profits out of the coins that are very heavily weighted so that they don't make up a majority of your portfolio. For example, if we just took things at market cap, Bitcoin, would be roughly 50%. And what rebalancing does, and especially with our market cap limit of 10%, is it sells off any market cap weighting above that and redistributes it to the other coins in the list, so that it's more of a diverse portfolio across many assets. And that effectively mitigates risk, as there's no single source or single asset that dominates the majority of the fund net asset value. And if it collapses, that would be very detrimental in a fund where a coin takes up the majority of that cap.
Okay, so just to give people like a practical example, let's say Lisk was number 20 in the market cap for a week. You guys ended up rebalancing and you allocated some of your total funds to Lisk. And then the next week, Lisk got bumped down and let's say it was coin number 25. Could you talk about how that whole process would happen from like selling the Lisk to buying the new asset?
Essentially, we've got a trading procedure that mitigates the risk of front running. So front running, I'll just give a little bit of background around that, is something that people can do to an index fund or any kind of fund strategy when that fund strategy is known in advance. For example, if people know, okay, Lisk has popped into the top 20, they know, okay, the Crypto20 index fund now needs to purchase this. So we've put in a pretty comprehensive plan around, how to mitigate that risk. And exactly how it would work is that we would, send the cryptos from our hot wallet to the exchanges, between a random time between 1 to 48 hours in advance of the trade. This is also, part of the justification behind having weekly rebalancing. We've got a longer time period in order to do these trades. And so that traders can't follow the hot wallet to know exactly when we make a purchase. The trades can be executed over multiple exchanges and at various times, within that rebalancing window. And essentially how it would work is, we would sell off that coin and we would just buy, the next coin. But it might, the weighting is determined by the various market caps, relative to each other.
Okay. Have you guys run any models to see what this looks like over a long period of time? Like, have you run a model over the last year to see, what happens if you tried to rebalance weekly for the top 20 cryptos?
We have indeed. So we've run 105, 175-day rolling windows with our data from the period of 1st of January 2016 till the 14th of August. And basically the rolling windows were implemented so that we could ensure the results were pretty time invariant. The reason we only use discrete values, for example, weekly, daily, monthly rebalancing, or the number of coins we tested 10, 20, 30, 40, is because we don't want to overfit the data. Overfitting is, as a data scientist, overfitting is when you take a model and you've got fairly limited data and you make the model really accurate on that training set, but the model doesn't perform very well in the real world. That's why we didn't select something like 23 coins or 17 coins, even though that might have been the optimal number in our back tests. It was, so that it could generalize really well going forward. And based on our tests, we obviously optimized the hyperparameters for rebalancing frequency, for the number of tracked coins, and for the cap ceiling. And, we ran those various tests over these rolling windows, and we determined that a selection of a 10% cap ceiling of 20 coins and with weekly rebalancing gives the best performance in terms of having broad market exposure with acceptable turnover and well mitigated risk by not having a single asset dominate. Mm-hmm.
Yeah, that's fascinating. So you guys tried out, I assume, like different allocations. So you mentioned like a ceiling of 10% for each coin. So each coin, regardless of its market cap, can't have more than 10% of the total fund allocation. But you also tried out different indices. So like a top 10, a top 20, a top 30, a top 40. Is that correct?
Yeah, so that's a pretty large search space. And we went through all of that simultaneously. Obviously you have to test every single one of those conditions at, every single rebalancing frequency and varying all the other conditions as well. So we did test all of those, and the results are in our white paper pretty comprehensively for more detail.
Oh, awesome. That's great. It's really interesting too, because as I'm sure you've seen, there's a lot of, I don't know if you could call it competition, but there are a lot of other sort of crypto index funds popping up around the same time. So obviously there's something called Hedge Token, which I talked to you a little bit about before the podcast. And they're actually doing the top 30 cryptocurrencies, whereas you guys are doing the top 20. I think there are some other ICOs happening in the future that are also kind of doing something similar, whether it's like a total crypto index fund or just an asset-based index fund or a platform to make, your own indexes essentially. But it's interesting. I mean, do you guys think that you are going to have the competitive advantage in terms of returns because you've gone through all that optimization and you found that 20 with a 10% cap is most optimal?
Yeah, I'd be very interested in seeing what the justification behind, the other funds' reasoning is. From my experience and when I've looked around, it's mostly just been, we thought this was a good number or something like that. I haven't found, much concrete data-backed evidence that, those numbers were the best. But in terms of index funds versus actively managed funds, for example, like hedge fund, which is an actively managed fund, the owners and the fund managers make decisions. I've got an April 12th, 2017 Forbes article in front of me. And over the past 15 years, 92% of large cap funds failed to beat the index. And this is in a market, in the stock market, there are decades worth of data and exponentially more data than, in the crypto sort of world where new coins pop up every week and there's very little information about them compared to, a company with annual reports and, various financial statements, etc. So my question to those actively managed funds in the crypto world is, where do they get the data? Where do they build the models, that are able to beat, the index where quants, machine learning scientists, companies with billions of dollars of assets behind them and thousands of employees cannot. They fail to do so. And then, these funds pop up, trading bots, AI type things, and they come up and pitch, strong returns and, AI powered X and Y. But the data is so thin that, you can't effectively build models on it. And, it's been around for such a short time. I struggle to see how anybody would be able to make that work, in my opinion. And index fund strategy is definitely the best way to go about investing in cryptocurrency at the moment.
Yeah, it's interesting you bring that up because I was doing a little research on the number of crypto hedge funds that exist now. And based on my research, there's approximately 55 that are actually open for business at the moment. But the supermajority of those actually launched this year. So there's this huge, I guess, new interest from traditional finance people that are trying to essentially open up a crypto hedge fund. I think you might have already kind of answered this with that explanation, but how do you think these funds are going to fare in the market, especially the people who may not have as much crypto experience and may have more traditional finance experience?
I think they'll find it very difficult. They'll try and invest, based on technical analysis or fundamental analysis. And that might do okay, for the top 2 or 3 coins where there's, very high liquidity. But buying and selling, in the top 20, top 30 coins is very difficult if you're going to have to make an investment decision as a, human being on every single one of those coins. So the interesting thing about this is, these hedge funds have been popping up because people want exposure to cryptocurrencies, but they also want it in a way that isn't, unacceptably risky. And traditionally, these cryptocurrencies have been seen by investors to be, unacceptably risky. And that's where an index fund comes in. It mitigates that risk by giving you a rebalanced portfolio of, many assets. But most people, they may not have heard of index funds or, the hedge funds that try and sell you these things. Most advisors won't sell an index fund because they don't pay a commission. Even though there is, significant evidence since, 1976, the inception of the index fund, that they've beaten actively managed funds, consistently over time. I guess most of these big companies don't sell them, the brokers don't push them because they can't take a commission on them.
Yeah, that's very interesting. And that kind of brings me to my next question about commissions in general. So in terms of the long-term viability of Crypto20, how are you guys going to survive in the long term? Is there a fee that you are taking that's just smaller than, a traditional managed fund fee?
Yeah, so that's the great benefit about an index fund is that, we don't need a team of 500 analysts sifting through stocks. We don't need that research team. It's all based on, an algorithm, a set of rules that are automated. So we don't need, expensive brokers, fund managers, etc. And we'll be charging 0.5% per annum of fund value, whereas, any other index fund around in the market is charging upwards of 3%. And I think the key differentiator between us and, other funds or other index funds that may pop up in the future is that we're not a platform, we're a finished product. So platforms need to pay the platform creators, they need to pay the platform token holders, and they need to pay fund managers who establish funds on their platforms, right? And we don't have to pay any of those people. So that's why we can charge, that fee of 0.5%, which they can never undercut. And, other funds like Iconomy's index fund in the market, they charge 3%. So we've got a big advantage in that space.
Yeah, that's huge. I mean, is that the main way that you think you're going to be able to differentiate yourself from all these other indexes? You mentioned Economy, where people can go on and make their own kind of basket of cryptocurrencies that people can buy into, many of which, or I guess one of which is the main Economy index, which is doing something similar to you guys. Do you think the fees is your main value proposition?
Well, in terms of real world investments, the reason that index funds beat actively managed funds most of the time is because of the fees. Fees are very strongly correlated with a fund's performance. The lower fees that a fund has, the more likely they are to outperform.
Interesting.
So this is, quite a key differentiator in that when cryptocurrency gains normalize, a couple of years into the future, and we're not seeing, 100% increases year on year because maybe it's roughly equal to the S&P 500. Somewhere at that time, when expenses will become a much, much larger portion of, an investor's return, it will be very important to keep a low expense ratio because you're literally just giving your, profits away to the fund managers at that point.
Yeah, no, that makes a lot of sense. It's easy now, I think, and that's why a lot of these people, whether it's Economy or Shapeshift, that makes you kind of, or I guess, allows you to create your own basket of whatever cryptos you'd like. And I know Shapeshift charges like 1% a month or something totally outrageous, so 12% a year. So I think it's easy. I mean, to your point, it's easy for them to justify these fees now, whether it's 12% a year or 3% a year with Economy. Just because the returns in crypto are so massive right now, at least the majority of the time, when we're not in like a 2013 Mt. Gox scenario. But it's really interesting. Is there anything else that you think you and your team are bringing to the table other than the fee? I mean, obviously you mentioned that you guys are putting together all these models and had kind of optimized your fund structure and investment rules. But is there anything else that you guys are doing differently than the competition?
So the way that we're going to go about this is to start off as an incredibly legitimate fund. We're established in the Cayman Islands, and we're going to launch a series of funds. This will be the first, and we will be recording all the data based on massive data sets that we can pull from all the exchanges, order books, price limits, trade volumes, etc. And using that, so I have another company, Data Profit, about 30 people, an international machine learning company. And once we've built up that massive data set after around 6 months, we will use machine learning to optimize the rebalancing procedure and to establish rule sets for new funds, or to generate kind of an AI traded fund when there is sufficient data, and when we've ensured that there is sufficient data to do so. So I think that's a pretty key differentiator in that we have a long-term plan for how we're going to do this, and the team is up to the task of doing so.
Yeah, that sounds great. So Data Profit, the company you mentioned, that's Data Prophet, not profit like Profit, I guess.
Yeah, so that's the one.
Okay. When did you start that?
In 2014. So that's been around for about 3 years now, and we've got a number of major international clients.
That's awesome. And so you guys are just going to kind of leverage that for Crypto20?
Exactly. So I think machine learning, lends itself to being much better at optimization than obviously a human. But you do need sufficient data. And that's not something that's available at the moment. And building up this data set will be a huge asset to the fund. And there'll be all sorts of interesting spin-offs that will be available as tech that we can develop once we have that data.
Yeah, it's interesting. I mean, especially in the crypto fund world right now, even like these ICOs that are launching their own crypto funds, which I think is a kind of an interesting concept. A lot of them are throwing around buzzwords like machine learning and artificial intelligence. Can you talk a little bit about what machine learning actually is for like the average listener that hears it a lot and they think it's kind of this futuristic thing? Can you explain what that actually means?
So machine learning is it's the ability for a computer program to improve its results, kind of with the use of an algorithm based on feeding it a lot of data. The example that I often give is, machine learning is if you show a 5-year-old child, 5 pictures of cats, the 5-year-old is able to identify what a cat is. If you were using traditional programming, methods, you'd have to specify, there's X or Y distance between the ears, a cat has 4 legs, all of these different parameters, which make it, incredibly difficult. But what machine learning is able to do is by feeding it hundreds of thousands of examples of something, it is able to discover, those parameters itself without being hard-coded in by a human. For example, you might take a photo of a cat and it might have one of its legs obscured just by the angle that it's standing at. And traditional programming would fail in that case, whereas, machine learning would be able to identify it still. Machine learning has made a lot of things possible that were never possible before, such as, self-driving cars, auto-tagging your face on Facebook, because Facebook's built up this 3D model of your face based on, all of your tagged profile pictures in the past. There's a lot of really cool, interesting things, recommendation algorithms, etc. But what it really is it's just a set of algorithms that are better at, the kind of mathematics that are a few hundred years old, linear statistics. Machine learning, consistently outperforms on that basis. And that's why people are trying to, punt it. But, it's really powerful and really useful, but without a lot of data and without sufficient data, and good quality data, it really won't be able to find a signal in that noise, and right now, the crypto markets are incredibly noisy. It'll be difficult, and nobody's really recorded any of this over a prolonged period of time. It's only been really the last year that altcoins have popped up and become more prominent and have overtaken Bitcoin, in terms of overall market cap.
Yeah, it's interesting. That's a really great explanation, by the way. Thank you for that. I think there are a lot of people going, oh, okay, I kind of understand what machine learning is now. But it's interesting. So how are you going to apply machine learning to the Crypto20 index fund if the parameters by which you invest are already kind of fixed at the beginning? Is there something additional that you're going to be able to bring? Are you going to be modifying? Yeah, go ahead.
So we won't modify the trading rules because I think that's quite important to keep fixed over time. But what we will change is, exactly when we do the fund, the asset purchases and sales. In the weekly rebalancing period, we have that entire week to do those trades. And what AI will be able to do is say, okay, Tuesday evenings at this X or Y time, or, predict live when the best time to be, would be to, lay off an asset or to, acquire one.
Okay, that makes a lot of sense. So just optimizing your rebalancing period, basically.
Yeah, I think that would be the best usage of AI at this time, I think.
Okay, that's great. And when you talk about artificial intelligence or AI, would you explain it in the same way that you explained machine learning just a couple minutes ago?
So machine learning is a subset of artificial intelligence, whereas it's kind of the only viable method of achieving any kind of AI at the moment. We don't have biochemical computers or anything like that yet. So machine learning is really the only practical form of AI around, but the words are essentially synonymous at this time.
Okay, interesting. And do you think I read an interesting sort of tweet storm on Twitter, where people do 1, 2, 3, and they continue, and they write a long form text piece on Twitter, and somebody was talking about all of the inefficiencies of the crypto market. So right now, obviously, there's extreme differences. There's huge arbitrage opportunities between exchanges, which people like Rialto, I think, are kind of taking advantage of building the first arbitrage fund for crypto. And there are all these other inefficiencies, whether it's the volatility or the difference in price on different exchanges, that people are taking advantage of and making money on right now. How long do you think it's going to be until those inefficiencies are gone because they're solved by people like you that are optimizing, when they buy and sell, or they're solved by people like Rialto, which are making the prices more consistent across different exchanges? Do you think we have another year of that, a few years? How long do you think it's going to take for like big finance people who have done this and have run data companies before, like yourself, to come in and eat up all of those inefficiencies and profit while doing so?
So in terms of the major stock market stocks, the top 500 in the US, the S&P 500, the crypto market cap is less than 1% of that, and the S&P 500 is a small percentage of the global investment market. So I think there's still a fair way to go for all of these exchanges to grow in volume. And volume is really the only thing that's going to, reduce volatility and arbitrage opportunities, etc. And I think that will come about in time. I don't know if it'll be very soon. I think the mainstream sort of retail investor is starting to pick up on cryptocurrency, and that's who I think Crypto20 is going to appeal to. But I would give it, a few years, a year or two at least, before, those opportunities are gone.
Yeah, that makes sense. And do you think, it's interesting with something like an index fund that's generally positioned towards people who are less familiar with the market. So like all these new people who are, they've heard about Bitcoin or cryptocurrency, Ethereum, whatever it may be, and they're looking to invest in some way. A lot of these people right now, just due to the regulatory framework of the US, for example, they can't take like some of their retirement fund and put it into Bitcoin. Do you all have any plans to make the Crypto20 index one of the main indexes that people could actually take retirement funds or part of their IRA and allocate it to that rather than, say, like the S&P 500?
Right. So an important part of investing would be to allocate a portion of your capital to growth. Obviously, if you're a young person, then you can allocate a larger amount of that capital to growth. And for example, a retirement portfolio has very little growth assets. It's mostly bonds and solid income assets. But what we will be able to do is, after being established as a Cayman's fund, we can go through all the regulatory procedures to be listed as a security in the US, and that would enable us to solicit investors below $100,000 minimum of the accredited investor limit, which would essentially be going to the general public, and that would be for the allocation of the 20% of their portfolio to growth assets or something like that.
Yeah, that's great. And do you all have a roadmap for that? I mean, is that something that you're planning on doing, or just something that you're considering at the moment?
Essentially, it all hinges on what the SEC believes is going to happen in the future of cryptocurrencies. If they believe it's too volatile, if they approve any ETFs. But we really are going to push for that quite strongly, especially with the fact that we're going to launch multiple funds in the future, which of which this is the first. I think it would be important for us to go after the US market eventually, fully compliant, SEC regulated way.
Yeah, that makes a lot of sense. And it's interesting, just talking about securities in general, a lot of people in the crypto space, they hear the word security and they like run for the hills just because nobody wants to get caught up with the SEC in any kind of way. But what people don't realize, I think, is that there are a lot of investment funds or, people have their money tied up in an IRA, and a lot of these investment contracts are written that they can only invest in securities. So as soon as, whether it's a token like yours, Crypto20, or something like some other crypto token that already exists, once that is actually deemed a security in the US, there's this huge pool of capital that can actually finally now flow into that asset. So it's not necessarily a bad thing. It's actually a good thing in the long term, I think, because it validates the space and also really opens up a huge amount of capital to come into it. Is that something you would agree with?
Yeah, and I think in terms of investing in securities, I think cryptocurrencies are much more naturally suited to securities than to some of the more esoteric utility uses we've seen. A security, is something that is immutable and transferable between people. And I think, obviously trading stocks and bonds and those kind of things on the blockchain would be much simpler, much easier, much more convenient method than, the way it is done today amongst the big banks. And I think that may drive down costs significantly. But I think, the real use cases we will probably see will be with securities in terms of the blockchain in the future.
Yeah, and it's interesting timing as well. Drew Hinkes, if I'm saying, I may be butchering his name, Drew Hinkes, he's an attorney. He specializes in Bitcoin and cryptocurrency. He was on a call with the SEC yesterday, which was the 16th of September at 2 p.m. Eastern, I believe. And he did a live tweet of it, which I thought it was really interesting. I wanted to pull up a couple things and just kind of get your thoughts or any comments you may have on him.
Sure.
Let's see here. He said the SEC said, and this is not a direct or verbatim quote, it's just what Drew Hinkes is tweeting. You can follow him on Twitter at Propel Forward. It's a really great live tweet. It happened about 21 hours ago as we're recording this. He says, just because using a token doesn't mean it is or is not within securities laws. So meaning just because a project is using a token does not necessarily make it a security by default. He then goes on to say, exemptions available, encourage market participation, to be aware and consult with Securities Counsel. Okay to reach out to SEC at fintech@sec.gov, which is kind of interesting. And I think it's a good sign there to see the SEC saying on a call publicly, hey, reach out to us, ask us questions. We're still kind of figuring out this regulatory framework as well. It'll be interesting to see how that kind of develops. I mean, do you have any thoughts on where you see that regulation going moving forward?
I think as more companies engage directly with the SEC, we'll get more clarity on that. But the way, and something is determined as a security, I'm sure is via the Howey test, which is several prongs. And just being a token doesn't necessarily make something a security, and it doesn't necessarily exclude something from being one. So there's a lot of interesting nuances around that. But as we've consulted extensively with our lawyers, and there is something you can do, which I would recommend a lot of these other crypto startups to do, is to pursue. It's fairly expensive, but if you're going for a high quality big cap ICO, you should probably approach the SEC for a no action letter, and that's something that can be negotiated directly with the SEC based on certain conditions, which would essentially guarantee them from not taking you to court down the line, or for pursuing some sort of criminal or civil action based on the way you've conducted your ICO. So that is a route to engagement with the SEC.
Okay, that's very interesting. So that essentially is like coming to an agreement with the SEC ahead of time, basically. Yeah. So
before you go public, or before you solicit investment from people, you should approach the SEC, and would essentially be a negotiation process between your lawyers and the SEC. And the eventual outcome of that may be a draft of a no action letter.
Okay, that's fascinating. That's something I have not heard of until this point. So that's very interesting. Do you know of any ICOs that have used that thus far?
I'm not currently aware of other ICOs that have used that, but I believe obviously the big ones that have gone through something like Filecoin, I'm sure they've had extensive consultation with their lawyers and the SEC.
Okay, interesting. There's one of Drew's tweets also at Propel Forward that I wanted to talk about as well and get your thoughts on. He says, continuing discussion, token value fluctuation suggests security. Basically saying that because token values are fluctuating or so volatile that that kind of makes them a security in a way. Would you agree with that, or do you think it still comes down to the Howey test?
I think, based in law, it's definitely the Howey test. Just the fact that something is volatile does not indicate that it's a security, in my opinion. I'm not too sure what the justification for that would be.
Yeah, and there's not a lot of context there, so I may be misinterpreting it, but that's just one of his last tweets. There were a lot of lawyers on the call, which was interesting. It seemed kind of like an open discussion between the SEC and this legal team. I know Drew is one of those people that's been in the space. I know Marco Santori from Cooley LLP. They have a huge crypto team over there. A lot of people just trying to kind of get ahead of this regulatory framework before it rolls out and maybe help shape it in a way. So it's very interesting. One of the things I want to talk to you about, you had something on your website called the CRIX, which, to give people an idea, the CRIX, or the Cryptocurrency Index, is a benchmark designed for the crypto market, developed as a joint work by the University of Humboldt and Singapore Management University. So is this essentially an index of the total crypto market cap? Is that what it's plotting?
Right. So the way indexes work in terms of investment funds is, you establish an index based on your parameters and you try and track that index. So, for example, the Crypto20 index would be 20 coins, 10% hybrid cap weighting, etc. They've determined a different set of hyperparameters based on, their own equations and rule sets. And that is the sort of benchmark that they're tracking. And it's just interesting for comparison. The way people, set up their benchmarks, and people can go and check out exactly how they went about doing that.
Yeah, and it's interesting because I saw that you guys weighted it as if whether you'd put a $10,000 original investment in Crypto20 or in CRIX and see how they performed, and Crypto20 performed way better, which I think is a testament to what you said at the beginning of the call, which is all the different models that you went through to find the most optimal structure.
Right. So in terms of that, it's largely because of the asset weighting and the market cap weighting is we determined, obviously, the altcoins have grown much more significantly than Bitcoin has. If you look at, sort of Ethereum's meteoric rise over the past year, as opposed to, Bitcoin. And essentially, reducing the market cap weighting to, that 10% limit on Bitcoin, etc., is what gives the fund that extra growth potential by allocating, those market cap percentages to the other coins in the fund.
Oh, okay, interesting. And I had an interesting question, speaking of Bitcoin. So Bitcoin obviously forked recently, and now we have Bitcoin Cash. So if you had any Bitcoin before the fork, you now also have Bitcoin Cash after the fork. It's essentially just a copy of the network, and they've changed, basically changed some parameters around the block size to allow for more transactions and things like that. But I had an interesting question for you. So obviously Bitcoin Cash is in the top 20. I assume that you're going to keep that in the Crypto20 index?
Yes, that's correct. So the way the fund works is that, it's kind of avoids the human emotion, human bias involved in investing. And it pretty much enforces that kind of strict discipline of just doing something by a rule set. And, not taking into account somebody's personal opinion on, Bitcoin Cash or Bitcoin, etc. It's really just based on tracking the index, which means, you get your fair market return.
Yeah.
And so we would keep Bitcoin Cash in, if a coin that we hold undergoes a fork, we would add it to the, fund portfolio, and we would just perform rebalancing as normal to get back to the 20 number of coins at the next period.
Oh, okay, great. Yeah, that was going to be my next question. If Bitcoin forks again in November with SegWit 2x, you guys, I assume, will be adding that forked coin also into the index?
Yes, so anything that's in the top 20. And if it is a coin that we already hold at forks, we'll add that into our regular fund holdings. It will become part of the fund pool, and we'll just perform rebalancing as normal afterwards.
Okay, that's great. So now I wanted to kind of pivot and talk more about the Crypto20 tokens and the ICO. So when I buy a Crypto20 token at 95 cents or $1, whatever it may be on the day I buy it, I assume then that I'm buying essentially $1 worth of value of the top 20 cryptos. But as the market fluctuates, how is the value of the token actually tied to the value of the top 20 cryptos? Because if Crypto20 is tradable on exchanges, it's just kind of being traded based on supply and demand rather than the actual value that the token provides, unless I'm misunderstanding something.
So this is something that I should have touched on earlier, actually, when you asked me what differentiates us. What differentiates us largely is our unique liquidation option in the smart contract. So that directly ties the assets, the underlying assets, to every single token.
Oh, wow.
So you as a token holder are able to, you can interact directly with the distributed application, or you can use the GUI, version of it on our website. But it would essentially be you send your tokens to that smart contract address. We liquidate the tokens for a market rate, all your underlying assets, and we send you the value back in Ether. So it's directly linked to those underlying assets at any point in time. Cool.
No, that's great, because I think that's one of the oversights I think that traditional funds, or not traditional funds, existing funds in the crypto space have done. You had Blockchain Capital that issued a token, but the token has no actual value that's directly related to the value of the underlying token. So it's interesting to see that you could just liquidate and actually get your percentage of those top 20 out. Is that whole process manual? Like, do you guys on the back end actually have to manually go through and liquidate everything, or is that something that your system will take care of as well?
So the interaction is handled by the smart contract. So that's all public code that people can vet, and we've audited it. It's available on our GitHub, and the back end process, no, that's all automated, handled by our trading system.
Okay, very cool. And when it comes to security, what are you guys putting in place to make sure that this system isn't abused or exploited at all? Are you guys getting audited? Yeah,
so we've got an audit by DLT Labs. They've worked with the R3 consortium. They've got pretty significant experience in detecting vulnerabilities and confirming that we're operating as the white paper. Doing a static and manual analysis of the smart contract, gas analysis, etc. And we will be publishing their report shortly on our public audit. We've also, had pretty extensive consultations with some of our advisors, PhD advisors, who have a lot of experience in this space, and they've advised best practices, for defense against civil attacks, bad actors, and so on.
That's awesome. So you did mention, when it comes to your roadmap, you did mention that the automation platform or the back end is already built. When do you guys plan to actually go live? Is it immediately after the ICO?
So we're going to have a brief period where we invite one of the big 4 auditing firms to come in and audit exactly how much we've received from the ICO, and we'll make that report public. We'll acquire the assets, and we plan to begin trading operations and have the first rebalancing procedure done before January 2018.
That's great. Well, I really appreciate all the insight into the platform. I think now would be a good time if you want to, educate people briefly on when your ICO starts and where they can learn more info. Now's the time to do it.
Sure. Thanks for the opportunity. So it is crypto20.com. That's CRYPTO20.com, or you can spell it as a word, crypto20.com. We've got both domains. And you can discover more about our fund structure there. You can read our white paper. We've got a fund sheet showing an example, on a day of what exactly we're holding. You can check out our investor portal where, we have our fund holdings over time, and, basically how to invest in the ICO. But the pre-sale will be held on October 7th, and the main ICO will start on October the 16th.
That's awesome. And is there anything else you wanted to add? Any exciting announcements or anything of the like?
I think we will be announcing, a fair bit shortly. The fund is we're just going public with it now, today, Sunday the 17th, and it'll be quite exciting.
Awesome. Well, Daniel, thank you so much for your time. I sincerely appreciate it. It does look like an interesting project, and it's always good to see an ICO that's done their due diligence ahead of time with the models and legal and all that good stuff. So thank you so much for joining me, and best of luck with your ICO.
Yeah, thanks a lot for the opportunity. It was great talking to you.
Thank you so much for listening to this podcast. I sincerely appreciate it. If you'd like to request someone to be on the podcast in the future, tweet us at ICO Alert and let us know. Most of our guests are requests from listeners just like you, so we review every single recommendation that comes through in our Twitter feed. We'll look at everything. So if there's a lesser-known project that you think we should cover, let us know. Maybe we'll have them on the podcast. If you haven't already, please do subscribe and be the first to hear our new episodes. And also, don't forget to check out ICOalert.com to see the only comprehensive list of active and upcoming ICOs. I'm your host, Robert Finch, and I'll be back next week with a brand new episode.